So today is a history lesson all about the Greeks on a variety of topics from politics to social structure to way of life. Just kidding, actually today's video is all about Greek symbols, specifically the ones you see while trading. These are some of the most powerful tools in determining risk and success of your trades, and the 4 symbols I'll cover today are arguably one of the most important tools to have when trading. With how volatile the market has been, it is difficult to predict which direction the market is headed, and even harder to figure out which stocks to trade. So without further ado, let's teach you all about the Greeks and how to use them as a powerful tool to take home massive profits. So what are the Greeks? The Greeks are mathematical calculations used in determining how much any given asset is expected to change in response to the passage of time. Now, the mathematics are used to value assets and determine whether or not the asset price of an option is appropriate. I'm going to get into the different symbols in just a minute, but a commonly used Greek is the delta, which is the rate at which an asset is expected to change in response to a change in the price of an asset. Greeks help you understand your risk when options trading. The Greeks are a set of numbers that help you understand the potential reward and the risk of the trade. The potential reward is related to the payoff of the trade, while the risk is the potential loss. The Greeks account for price, volatility, and time. Price is the most obvious, but time can be important as well. Risk and volatility are related to the probability that an asset will increase or decrease in value and can be measured on a scale from 0 to 100. These 3 dimensions are important for creating a bulletproof trading strategy. Moreover, price is how much an asset is worth, time is how long it will take for an asset to change in value, and risk is how likely an asset is to change in value. The Greeks are a set of financial indicators that measure the risk associated with options trading in a very comprehensive way. Remember, it's easy to get overwhelmed when you first start trading options. So knowing what the risk is and understanding your options will make you trade and make decisions better. Now, I get it, options trading is an extremely complex area of finance. It's a field where mathematicians, physicists, and social scientists have poured their heart and soul into understanding the dynamics of the market. However, most traders still have no idea how these mathematical equations work and how they can be translated into action. So here are the 4 most important Greek symbols to know like the back of your hand while trading. First, we have the delta. The delta is basically how volatile the stock is, and its value ranges from -1 to 1. A delta of 1 means that it's a very stable stock with an identical move in price of a derivative. A delta of 0 means that the stock is moving very little. The delta of a stock is calculated by taking the change of the price of the stock and comparing it to the price of the underlying stock. Ultimately, this will tell you the amount that the option contract will either gain or lose in value based on every dollar move in the price of the stock. So when playing more expensive stocks like Tesla that moves maybe $30 a day, there's a lot of risk involved. Second is the gamma. Gamma is a statistical measure of the rate of change between an option's delta and the underlying asset's price. It's the amount by which a portfolio's return is expected to vary from the average return of a stock. An increase in gamma is associated with an increased movement in delta, even with a very small price change. Next is VEGA, which is often used to measure the risk of a given trade. It is calculated by taking the average of an asset's daily standard deviation. Now, VEGA ranges from 0 to 1. Remember, a stock with a high or a long VEGA would have greater volatility than a stock with a low VEGA, and high volatility can result in drastic market swings, whereas a short VEGA portfolio is indicative of volatility vulnerability. The last symbol is THETA. THETA is a measure of time decay. It's commonly applied to the pricing of options. THETA is typically expressed as a percentage per day. For example, if a option has a 1-day theta of 0.50% and the option's strike price is $50, then the option's price will fall by $1 for every day it remains in the market. Theta is the time value of an option, which means that the option loses its value as it gets closer to its maturity. Now, I know financial markets are often fraught with unknowns, and the downside to the market is that they don't always play fair. It is, in many senses, impossible to trade without any knowledge at all. This is where you need to understand the basics of what's known as the Greeks. The Greeks are ultimately a set of key terms of finance that help to describe the relationship between the price and the likelihood of that price moving in any given direction. Anyways, I hope you understand the Greeks a little bit better in this video, and I hope you got some value out of it. Hey, if you did, please do me a favor and leave a like and subscribe to the channel if this is your first time here. Anyways, I look forward to seeing you in the next video. Peace.